Adyen is one of the largest payment processors in the world, but the stock has dropped over 70%, taking the share price to €674 a share. That gives the company a market cap of €21 billion. With €2 billion of cash on the balance sheet, the enterprise value is €19 billion. Adyen recently changed the way it reports revenue, so net revenue for the last 12 months was just under €1.5 billion. Meanwhile, net income was €564 million, with €692 million of ebitda and €849 million of free cash flow. That means Adyen is now valued at 13 times net revenue, 37 times earnings and 27 times ebitda. That figure is below the recent average. In 2021, the stock was trading at over 150 times ebitda. That valuation was clearly unsustainable. Even so, it's worth looking at why Adyen stock has fallen so sharply. The main reason is slowing growth. Volume growth has fallen by roughly half in Adyen's digital, unified commerce and platform segments. Platform growth is particularly concerning. It grew only 3%, and this could indicate pricing pressure from rivals like PayPal and Stripe. In addition, Adyen's results missed analyst estimates by a wide margin. ebitda was 15% below expectations, and ebitda margins have now fallen from 58% 2 years ago to 43% today. But Adyen remains a highly profitable business that continues to generate large amounts of cash, and the decline in ebitda margin can be explained by the company's decision to increase hiring, which could pay off in a couple of years' time. Adyen has been praised in the past for its culture and financial discipline. In 2022, only 7 employees earned more than a €1 million salary. Stock-based compensation is only €30 million. At PayPal, that figure is over $1 billion. Looking at the bigger picture, the majority of global payments are still being processed by legacy players like Chase, Fiserv and WorldPay. If Adyen can continue to take market share, then it should have plenty of growth ahead. On the other hand, there's so much competition in this space, we could see a race to the bottom in pricing. Adyen management sees things differently, however. Company guidance is for revenue growth in the mid-20s to low 30s, with ebitda margins getting back up to 65%. Let's assume a more conservative scenario where Adyen grows net revenue 20% per year for the next 5 years, with an ebitda margin of 50%. In that scenario, the company would be making roughly $1.8 billion in ebitda in 5 years' time, and if you apply a 25 times multiple to that, you get a valuation of €46 billion, which works out to an investment return of 19% a year. So Adyen has the potential to generate excellent returns. Competition is a big risk that needs to be monitored, but with Adyen's history of growth and financial discipline, I think the stock is worth backing. That's why I give the stock a bullish rating, but these are my personal opinions, not financial advice, and I do own some shares in Adyen. For more detailed investing ideas, make sure to visit our website overlookedalpha.com.